Hello and welcome, subscribers, to the Saturday Summary for July 5th, 2014, your weekly summary of market and economic news for annuity and life insurance professionals. I'm Jonathan Illig, Executive Sales Consultant for Brokers Alliance here for The Biz. I hope everybody had a great 4th of July celebration. Well, the shortened trading week was an early long weekend celebration as the equity markets continued to climb to new highs on the S&P 500 and the Dow Jones Industrial Average. This was another hot air-fueled week as Fed Chief Yellen, in a midweek speech to the IMF, said that she does not think that monetary policy, that is interest rates, are the way to control overheating asset markets, stating that she thinks regulation, that's fiscal policy, the purview of Congress, needs to control against asset bubbles. Yellen also stated that the Great Recession after 2007 bubble burst was not the fault of the Federal Reserve's low interest rate policies, implying that it was a result of regulatory failures. I think that's strange words from the chief U.S. bank regulator, don't you? Well, many pundits opine that she is putting the Fed alibi out in advance as this largest asset bubble has grown larger. Big investors interpreted Yellen's comments as confirmation that the Fed will keep interest rates low, thus the markets rallied. Now, the bond market didn't buy it, though, and yields climbed this week. The benchmark U.S. 10-year Treasury note yield increased 3.79% this week to a Thursday close at 2.64%. Now, on Thursday, as the markets closed for the week, the volatility index, or the VIX, was at its lowest level since February of 2007, and it has now been over 1,000 days since a correction, that is a drop of at least 10% in the markets, has occurred. This is the 5th time in history that this has happened, and it's the longest pain-free rally since a 1,127-day run without a 10% drop that occurred from July 1984 through August of 1987, which ended, of course, with the crash in October 1987. Now, you can read more about this in the article on page 7. All other bull market runs of this magnitude have occurred in times of healthy economics, and certainly not in times where quarterly GDP print was negative. Draw your own conclusions. What about this week's jobs report? Didn't U.S. unemployment drop to 6.1%? It sure did. But as usual, one must look behind the curtain. While the jobs report was positive in the number of jobs added, analysis of the data revealed that the number of full-time jobs declined by over 500,000, while the number of part-time jobs increased by 800,000. This is the biggest increase in part-time jobs since 1993. Now, the data also revealed continued wage stagnation, which was taken as good news by Wall Street, as this is the era of bad news for Main Street is good news for Wall Street. Why? Well, they believe the central banks will continue with their zero interest rate and stimulus policies for the big investment banks, which of course has been a primary driver of this bull markets in stocks. Now, on an entirely different note, an article related to retirement planning caught my eye this week, and you can read it on page 8, entitled "Online Retirement Calculators Don't Calculate This." This article correctly points out the importance of cash reserves in retirement, not only for emergencies, but also for what's called replacement costs, such as, needing a new roof, replacing cars, things like that. Well, the author points out that online retirement calculators don't take this into consideration, and he states, "Use a retirement planning program that allows you to enter discrete costs in the future years that replacement might be necessary." And goes on to say, if you're incapable of doing this yourself, get the help of a professional. It'll be the best investment choice you can make. Well, at Brokers Alliance, our producer clients have access to a retirement income planning system that does take these replacement costs into consideration and basically program them in as part of the overall retirement income forecast. Now, access to this highly flexible and detailed retirement income planning process is integral to Brokers Alliance's unique and proprietary IFL Income for Life program. However, the author of this article misses a more important aspect of retirement income forecasting that is also inaccurate in retirement planning tools, and that's how inflation is calculated. And again, our system at Brokers Alliance corrects this by using our smart inflation method. Now, the inflation calculation problem is that commonly based and commonly used methods of projecting the effect of inflation upon retirement income uses a single inflation rate applied to the total retirement income need over the course of the retirement duration. And it typically is inflating the pre-tax income need as opposed to the expenses that are paid with after-tax dollars. And it also doesn't take into account changes to major expenses over the course of the retirement duration. Now, this often results in a retirement income need that looks like it's much higher than it really might need to be, thus increasing the return and therefore the risk that the consumer believes they must achieve in order to provide the income they'll need in retirement. Now, as an example, assume the total after-tax expenses in the first year of retirement equal just a little over $116,000, and this first-year income need is inflated at 3% compounded per year. We see the results of this here. With this method, the total retirement income need at the 10th year of retirement is nearly 50% higher than in the first year. By the 20th year, the increase is nearly double that of the first year. Now, this was hard enough for the client to do while they're working, and now this calculator is telling them that they have to do so while retired, when at the same time, the industry is telling them that they need to reduce the risk to their assets. Thus, the client believes they must achieve a higher rate of return on their assets and therefore take greater risk. Or they think it's just not possible and they do no planning at all. Well, Brokers Alliance Smart Inflation method applies inflation only to the anticipated after-tax expenses, assigns differing rates of inflation to different types of expenses, we call that line item inflation, and accounts for known or anticipated changes to major expenses over time. The Smart Inflation method uses the same beginning expenses, but produces an inflated income forecast that is typically significantly lower, yet is a better prediction of the actual income that will be needed in retirement. With the lower income need, the client can take less market risk to achieve the income need. You can see a comparative example of this in the written Saturday summary. Call Brokers Alliance to learn more about our inflation forecasting method and our retirement income forecast. Finally today, as markets continue to ignore the increasing geopolitical risk in the Middle East and the Ukraine, I'm going to close with this. This is the front page of London's Financial Times from June 30th of 1914. Reporting that the markets were unaffected by the assassination of Archduke Ferdinand on June 28th of 1914. Now, within a week, Germany invaded Belgium and the First World War was underway. Now, in today's era, Wall Street would be telling average investors not to worry. The geopolitical risk was already priced in. Well, that's your Saturday summary for Saturday of July 5th, 2014. Again, happy 4th. Have a great weekend. We look forward to seeing you next Saturday.